Hey guys, this is Justin. On April 30th, we interviewed 24 guests in a 12-hour live stream to raise money for Susan G. Komen in conjunction with our friends at Spot Gamma. Our guests were some of the smartest market experts we know, covering topics ranging from value investing to factor investing to macro and options. We are releasing each of the interviews in pairs of 2 over the week following the live stream to bring our guests' insights to our audience in shorter videos and to continue to raise money for a great cause. If you are able to, we encourage you to donate using the link provided alongside each video. As always, thank you for listening. Please enjoy our conversations with Simplify's Mike Green and Mike Taylor.
We are very excited you decided to join us today. We're happy to be here to support Susan G. Komen. We're also excited to have somebody that your colleague Mike Taylor just called, I believe, tall, handsome, and brilliant.
You said handsome.
Yeah, well, he's right
twice.
about the tall part. No, I actually had the pleasure of listening to Mike talk. I think he's, everybody forgets how incredible he is from just an insight standpoint. Really privileged to consider one of my good friends.
Yeah, he is really smart. I mean, the ability to blend macro with what he's doing on healthcare, it's very, very cool what you guys are doing with Pink, raising money for Susan G. Komen.
He's really, really smart, but it is actually important that people understand that he was the single last person admitted to Gettysburg State University in his class. So brilliance was not what he was known for early on in life. He was a snowboarder, and he ultimately changed the trajectory pretty amazingly. So one of my favorite interactions on a regular basis.
Well, it's good to get you on here and get a little bit of the inside info on Mike here after the fact.
Well, I represent the non-snowboarder demographic. So
yeah,
anyway,
I'm a
let's
skier
go.
myself. But anyway, yeah, we only got 30 minutes, so we probably should get going. Just a reminder to everybody, we're here for Susan G. Komen. And if you're watching on YouTube, there's links to donate. If you're watching on Twitter or on LinkedIn, you can come to YouTube to either one of our channels, Spot Gamma or Excess Returns, and give. And if you can give, we'd greatly appreciate it. So Mike, I think we want to start off in macro with you. We're in a pretty interesting space right now. We've seen at least the measured inflation numbers have come up a little bit. The higher for longer camp seems to be winning in the markets a little bit more now. More people seem to be, as Andy Constant calls it, the island. More people seem to be moving over to the higher for longer island. Can you just give us your take on where you think we are right now?
Yeah, I mean, look, I've been very straightforward and candid about this. I think one of the unique dynamics that's going on right now is people very much want things to be bad, right? They want things to have high inflation. They want the Fed to be trapped. At the same time, they're using that really as a narrative to describe why markets are higher, right? The Fed is ultimately weak. The Fed is going to be forced to cut. The Fed is going to do X, Y, and Z. And meanwhile, this idea that inflation is persistent and continuing certainly can be true, but it is absolutely a projection. If we look at the underlying components of inflation, the areas in which we're seeing inflation today are the follow-on components to it, right? And so I'll just give a really simple example of that I've walked people through before. But if you think about what happens to auto insurance, for example, when the price of a car goes up, the cost to replace that car under an insurance framework goes up as well. Ironically, you're not paying any more for insurance. You're insuring a more valuable asset, and you should see your insurance costs go up to reflect that. And unfortunately, that is what we're seeing at this point. We're now seeing the pass-through effects of higher auto prices, higher auto part prices that are already in the price level into things like insurance. That's a regulated industry. And so the insurance regulators are looking at it from 2 standpoints. One, we have to defend the profitability of the insurance companies because we want to make sure that they are viable in terms of meeting the coverage that they have sold. And so they will allow a price increase of this type of magnitude in response to the increase in the costs that are realized that showed up as very poor fundamental performance for insurance companies roughly 2 years ago. But the difference is high insurance prices don't cause auto prices to go higher. Right. So we're at that second stage in this. In fact, what high insurance prices do is they cause auto prices to fall for the very simple reason that people turn around and say, hey, I'm not going to buy a car. And it perversely shows up, unless you hedonically adjust these things, who are the people who can't afford to insure their cars? People who are poor and at the lower end of the spectrum and are already struggling with this. So this shows up as effectively a regressive tax that then reduces their access to cars in a way that actually creates all sorts of other ripples through the system, but largely involves a slowing down, right? That is different than a cost increase for cars. And it also ironically shows up in things like the demand versus supply components, because those are not properly tuned to capture this dynamic, right? If you think about the way those are supposed to work, they say, did price increase, and did that price increase cause demand, or did quantity consumed rise or fall? That's how those types of things work, right? Well, if I buy a car and my insurance cost goes up, am I buying more or less? I actually am not changing anything really, right? And so there's a slight increase in the quantity in force that shows up as, oh my gosh, this is a demand driven increase in prices, right? Unfortunately, like it just doesn't work that way. And so there's limitations to all this sort of stuff that happens at every turning point in every cycle. Some people want to project forward on a linear path towards inflation. Some people want to project their political outputs. And that's really what we're ultimately seeing in the inflation data, where it has become effectively a political argument. Biden causes the inflation, or Trump caused the inflation, or, XYZ, right? And we see this. If you look at the Michigan report in terms of the outlook for the next 5 to 10 years, the really notable component is not the change in the median expectation, which has actually been fairly constant. What's really remarkable is the growth of the tails. And so something like 20% of respondents all of a sudden are saying, we expect inflation over the next 5 to 10 years to be 10% plus, right? Why do you think that? Well, because it's inevitable, money printing, right? Like these are not fact-based statements. We've introduced an extraordinary degree of emotionality into it that just doesn't really match the underlying data that we're seeing.
So I mentioned before the rise in the reported, inflation metrics recently. I mean, do you think what we're seeing in those reported metrics is overstating the true level of inflation we're seeing right now?
I don't think there's any question about it. And I find it ironic that people who 2 years ago or 3 years ago would criticize owner's equivalent rent and say it doesn't report true inflation are now suddenly defending it and saying, oh, look, owner's equivalent rent. And that's not coming down anytime soon, right? Even as metrics that are incorporated within the owner's equivalent rent look at what's happening on the margin where all prices are ultimately set. And things like the Cleveland New Tenant Rent Index are falling very rapidly.
Do you think there's a better way to do inflation? I mean, we have things like Trueflation right now that are trying to do it in real time. Do you think there's a better way to measure inflation than the way we're doing it?
Well, I think unfortunately, inflation is one of these things that's a little bit like pornography, right? Everybody has their own taste and experience in it. It was a joke. Obviously, when you see it, right? Nobody actually knows what my inflation experience is or what your inflation experience is. We all have independent ones that are tied to where we live in the country, what we desire and what we like. And if you happen to be somebody who is basically tied into the marginal behavior around that, right? So let's talk about a population expansion like millennials. Well, if you're buying the same thing as an expanding population, you're going to, by definition, experience a rising inflation component to it, right? On the flip side of that, if I look at a lot of the things that people really do buy in their lives on a continuous basis, things like automobiles, things like durable goods, things like televisions, things like speakers and entertainment centers, things like milk, eggs, etc., all of those have largely retreated. I mean, the simple fact is wheat prices are at the same level that they were 50 years ago. Right? Just stop and think about that. When we start talking about the deflationary forces in the 19th century, we're largely talking about a basket that involved things like wheat. We're talking about scraps of cloth, right? Jack, how much did you spend on your last scrap of cloth?
Yeah, it's been a while. I guess you could call some of my shirts a scrap of cloth, but
that's exactly right. We
and I didn't
throw
spend that
stuff
much on
away
this
now because we have so much, right? So our consumption baskets have changed. They've become far more complex. They've become far more effectively protected by intellectual property. That's the only thing that keeps an iPhone cost up, right? It's the fact that I can't slap that label onto a Huawei phone and call it an iPhone and be able to sell it in effectively the same thing. They're all functionally identical except for walled gardens that are created by intellectual property restrictions. And the dynamics of the inflation component, the price of wheat has no material impact on American consumption patterns anymore.
So when you look at the Fed right now, do you think they're too tight? I mean, there's different camps in that. One looks at like the rate relative to what might be the neutral rate and say the Fed's really tight. Other people look at like financial conditions type indexes that include the stock market and things like that and say the Fed's not that tight at all. Like, how do you think conditions are right now?
Well, so I think conditions are, again, split by who you are, right? So if you are somebody who has borrowed and currently has debt outstanding, we typically call those young people, you are struggling, right? If you are somebody who has accumulated savings over your life in anticipation of spending down those savings in your retirement, you're suddenly sitting golden because the assets that you had accumulated are now offering you an income stream that is far above what you would have expected just a few years ago. And so this is exactly what we ultimately see. We see boomers benefiting, the older generation benefiting, the wealthy benefiting from this dynamic. And those who are at the lower end of the socioeconomic strata, they've actually seen, or at the younger end in particular, they've seen their prospects deteriorate materially.
So when you think about what the Fed should be doing here, I mean, they're meeting tomorrow. What is your view? I mean, do you think they should be cutting rates right now?
I think they should be cutting rates, but again, it's something that is totally up for debate depending on what your objective outcome is, right? If you think, as the Fed does, that higher interest rates are contractionary and that they should ultimately be driving inflation lower, then it becomes a question of how do you interpret the inflationary data that we've received? And what we're seeing are things like insurance costs going much higher, the cost of banking services, what's called the imputed cost, going much higher. At the same time, we're not seeing the same material benefit from the retreat in things like oil prices or energy prices that we saw last year. And so that's showing up a bit more in the headline and even in the core data, where again, that is effectively being pulled forward, right? We show insurance costs as core. We show banking services as core, even though nobody is actually writing a larger check to JP Morgan for their banking services. They're actually just receiving less relative to what they could get in a money market fund. And that's interpreted as a big increase in the cost of banking services. The fact that we now have to pay higher rates for securities lending because of an increase in the prime rate and the consolidation in the brokerage industry, that's interpreted as inflation, right? As far as I can tell, that's caused by the Fed and by our failure to enforce antitrust dynamics.
How much control do you think the Fed has here over inflation? You know, you could argue long rates are much more important for the economy. Do you think they have, you could also argue in like a fiscal dominated world, they're less powerful than they once were. How much control do you think they have over the rate of inflation?
So I don't think they ever really had that much control over the rate of inflation. If they actually did, we wouldn't have seen the structural dynamics of inflation behavior that's been largely tied to demographic features for the past 70 years. Right? Like it feels insane to say this to people, but when you actually think about how powerful the Fed is, what the Fed does control is the front end of the curve. And if the Fed decides to keep the front end of the curve elevated, let's just say randomly, Jerome Powell is reinstituted for a 20-year term and says, at no point in my term will the front end curve fall below 10% interest rates. Right? Well, what has to happen to the 10-year bond?
Yeah, it's going to go up.
It has to go higher in yield. Does that mean it's the right yield? No.
Not necessarily.
Right. It's what Jerome Powell thinks. And so that's really what's actually happening right now is the uncertainty that's being created in the front end is actually transmitting itself to the back end. It's not that the economy is getting markedly stronger or that we're seeing an improvement. The first quarter GDP growth, which by the way, the now casting components on a nominal basis missed by over 250 basis points. That's an extraordinary miss when you really think about it. It's not so much that the headline being at 1.5% versus expectations of 2.5% was the big miss. It's that the nominal number was such a huge miss, right? That's actually a really important development in my view.
How do you think the election affects economic policy? I mean, people will argue the Fed is trying to juice the market in the election or government officials are trying to juice the market in the election. How much do you think that affects policy?
Well, I don't think there's any question that the, political leaders, which would include the Secretary of the Treasury, right? So remember, there is no independence for the Treasury. That is an appointed position that serves at the pleasure of the president, subject to confirmation, obviously, by the Senate. If you think about that entity being political, there's nothing new there, right? And so do I think that it has an impact? Of course it does. Do they have degrees of freedom that allow them to do anything that they want? Of course not, right? They don't have the power. They don't have the capability to meaningfully cut taxes or to meaningfully raise taxes. They can propose it and it can be passed under Congress, right? But Congress ultimately controls that path. There is a legitimate concern that fiscal policy has increasingly moved to the executive branch because of the fears of the inability of Congress to act, things like getting rid of student loan payments through executive orders or mandating that regulatory agencies don't report things like delinquencies on student loan payments, those can absolutely be accomplished politically. But it's really fascinating to actually look at what's driving the, increased level of deficit. At this point, it is all about the interest rate policy. All of the increase in deficit is being driven by the Fed itself at this stage. So ironically, all the concerns that people have around very high deficit levels would be largely solved if the Fed started cutting rates. And that in turn would then cause a secondary feature. If the Fed starts to cut the front end of the curve, then you can actually finance the back end of the curve. Right now, it's very hard because of the inversion in the yield curve to take a levered position in something like 10s or 30s. You can do that as the front end, and particularly in 2s, by the way, but you can do that as the front end of the curve falls in price, falls in yield, to be more accurate.
Just one more before I hand it over to Brent. I wanted to ask you about, you mentioned the deficit, and that's something many people are worried about right now, both the deficit and the large national debt. And some people will say that is a huge, huge issue for our country going forward. How big of an issue do you think the national debt is?
So I don't think that all right, first of all, let's separate them into two components. The national debt can most easily be thought of as failed economic policy that didn't contribute enough growth versus the initial expectations, right? If you actually had made investments that drove significant growth in the United States, then we wouldn't actually be looking at the debt levels that we have. So really what the debt is telling you is this prior policy was not particularly good. That should not be a surprise to anyone who has actually observed policy over the last 20 years, right? Going forward, now the question becomes, do we spend that money well or do we spend it badly? And unfortunately, there's a ton of evidence that we're not spending it particularly well. Right. That's what occurs when, you effectively, as Lacey Hunt says, increasingly have to devote the resources to paying off the mistakes that were made in the past. Had we spent that debt to build more roads, had we spent that debt to rebuild our nuclear industry so that we had unlimited supplies of low-cost baseload power, had we decided to spend that money on productive capability and effectively created a competitor to China that we're now being forced to suddenly reevaluate, right? Or to make investments in education that actually cause children to be better prepared for the workforce today, we wouldn't be struggling with these issues. But we didn't do that. And so now we have to deal with the ramifications of it. So is the debt a problem? Yes. But what it's telling you is that policy is the problem, not the actual debt itself. The debt is really equity when it's happening at the sovereign level. Right? Saying, what are the claims on the resources of our economy? And we got a ton of claims that are tied to prior mistakes.
Do you think that policy can be adjusted to address that, or is that unlikely to happen?
So Adam Smith has a very famous line. There's a lot of ruin in a country, right? Particularly a country like the United States, which has extraordinary physical resources, which really does not have to spend that much of its national defense on defending itself because it has oceans on either side of it, relatively secure borders with relatively favorable neighbors, right? We don't have to spend that much protecting what we have. We're spending an awful lot of money basically trying to protect everything around the world and create conditions under which the world order doesn't change all that much. I'm not sure we're spending that money particularly well, is the argument that I would make. And it just comes back to the same thing. I don't think people are thinking in these terms, right? They're thinking in the terms of, this is impossible. We can't demand more. The system is ultimately totally corrupted. We need to get by with less, right? We've just lost the growth mindset. We'll eventually recover it. I think I'm highly confident that we will eventually recover it. But how long that takes, I can't tell you.
I know that Chris Cole, and I was listening to an interesting podcast interview with Grant Williams from November of 2020, and it was really interesting to listen back to that because it was he really forecast a lot of the things that I think were playing out today. And if I frame this correctly, he thought that we basically come to this situation where we're going to have to choose sort of a left tail or a right tail, and that had to do with monetization of debt or sort of taking the pain for some of our past mistakes, so to speak. You seem to think from your conversation, from what I'm pulling from what you're saying is that we can kind of hit the ball down the fairway. It doesn't necessarily have to be this left or right tail, outcome of everything that's happened really post COVID. Are you familiar with that sort of idea? And am I reading you correctly there?
Yeah, no, I think we're saying the same thing, right? Which is the debt is effectively a measure of how much of the resources you have to put towards prior bad policy, right? And one way of getting rid of that debt is to effectively hyperinflate it away, right? Or to take advantage of the dynamics that we print our own currency and effectively cancel out the debt. The irony is the way that would take place is through, you can't actually just inflate the debt away, right? The great irony is if I look at the decrease that we've seen in the debt to GDP number, it's been a function of growth, right? Not just a function of inflating, right? We haven't done that much damage in terms of inflating at this point. And candidly, I would highlight for people, like, remember, we expanded our money supply 35%. We shut the entire world down. We started a war in Europe. We started a war in the Middle East. We are currently engaged in conflict with China. We shut down the Suez Canal. We had to reroute everything around the Cape of Good Hope. The water levels in the Panama Canal are limiting transit through that mechanism, et cetera, right? Basically, everything's going crazy wrong. And we're arguing about 2.5% versus 3.5% inflation numbers, right? Now, have we had a cumulative inflation of 25%? Almost certainly. Has the price level shifted to reflect those prior mistakes and the fact that we did not contract demand adequately in the face of lower supply? 100%. But like, people should really be thinking about all the things that we screwed up and how little impact it actually had. Like, that gives you some idea of that degree of how much room there exists in a country. And again, like, I'm in this weird position where I am hypercritical of the choices that we're making from a policy standpoint, but also highlighted for people that, like, to immediately project the end of the system, that the world is coming to an end, that inflation is going to run rampant, that they are in charge and are acting against our interests. Like, this is just political paranoia.
That's a very pragmatic view they have there.
Well, it's pragmatic to the extent that it actually ends up being right. And so, I'll just say very quickly that it's been wrong. I mean, the simple fact is that the U.S.'s financial house is in much better order than China's, much better order than Europe's. Right? We actually know these things. And yet, weirdly, we talk about the collapse of the dollar.
Well, I would also say, to your point, we talked about this several times with some of the other earlier guests, that volatility has really been pretty contained, even through 2022, I guess you could argue, even though we threw so many problems right at it, politically and fiscally and everything else.
Well, yeah, I mean, you've heard my explanation for 2022. I think that 2022 was much more tied to systematic portfolio rebalancing. And candidly, I think the lack of demand for interest rates is tied to the same thing. So if you build portfolios that say I'm going to be 50-50 equities bonds, right? And nowhere in that statement do you include, but I'm going to actually look at the level of yields, right? Or I'm going to consider valuation in equities before I make that statement of 50-50, right? Then you would actually expect exactly what we saw in 2022, which is the Federal Reserve hikes interest rates. Mechanically, that lowers the price of bonds. If I'm running a 50-50 bond equity portfolio and bond prices fall, what do I have to do? I have to sell equities, buy bonds, right? And so that's what we saw in 2022. Did we see a recession? Did we see a significant retreat in profitability? Did we see corporations stop buying back their own shares? In some cases we did, but for the most part, it was largely a story about a match in behavior between bond prices and equity prices that's consistent with this dynamic of systematic portfolio allocations. If I look at what's happened since, the Fed has paused interest rate hikes, right? We've increased the supply of bonds and we've decreased the supply of equities because we ended the SPAC nonsense and we've started shrinking share counts again. Well, if I'm running a 50-50 allocation in which my demand is largely fixed and the supply changes in the way I describe, I expect to see equity prices go higher and bond prices to go lower. And unfortunately, I think that's really what we've seen. I just don't think there's information content in the way that people think there is in the behavior of financial markets at this point.
And then is that due to a lot of the financialization of markets, essentially?
I think it's due to a combination of financialization and also the rigid application of rules that, if you stop and think about them, don't make any sense, right? The idea that I'm going to allocate my portfolio on a fixed basis after we've seen the type of change in interest rates that we've seen is extraordinary, right? But if I look at a Vanguard website and I look at the expected return to bonds in their portfolio construction techniques, it's totally unchanged from where it was in 2021.
Right. Fascinating.
Right. So why would I change my portfolio construction if my expected returns remain the same? Even though we know that that's prima facie absurd. We've gone from negative 3% real rates to positive 2.5% to 3% real rates. And everybody's saying, well, bonds are certificates of confiscation still. Well, they have to be at least slightly less certificates of confiscation, right?
Right.
But nobody's thinking about them that way.
Well, Mike, thank you for doing this. I guess you have proven Mike Taylor's compliments correct.
I am tall, you're right.
Yeah. Well, you're not standing, so we don't know that, but the brilliant part you have. So thank you again. We really appreciate you taking the time.
Nice talking to you.
Mike.
Hey, how you doing?
Good. How are you? Thank you for joining us. We appreciate it.
Back so my head gets smaller. Like it's big enough already. I'm trying to get the pink in there. Okay, we won't. We're just going to get my
perfect.
goddamn face.
Oh, well, we really appreciate you taking the time to talk to us today.
Oh, my pleasure. Thank you so much. Thank you for putting this together.
Yeah, it's our pleasure. And as we'll talk about in a minute, you're doing, we're doing a one-day thing here for Susan G. Komen, but you're doing something every day for Susan G. Komen, which we'll get into when we get into the interview. But first, I just want to intro you. You're the manager of the Simplify Healthcare ETF. You've worked at a lot of hedge funds that would never hire me under any circumstances. You were a scientist. If we wanted to talk to somebody about healthcare, you are definitely the guy to talk to. So again, thank you for joining us.
Thank you so much for having me. And healthcare is a humbling because we don't have it all figured out. I don't have all the answers. In fact, my wife would tell you I have none of the answers, and if I did, they're wrong anyway. So it's a pleasure to be here, and thank you so very much. I'm so glad to help out.
But there are so many cool things going on in healthcare right now, and we're going to get into those with you because from someone on the outside, I probably don't understand them that well, but there's definitely some groundbreaking stuff going on. So as we go through the interview, we're going to get into that. But before we start, I just want to mention again why we're here. We're here to support Susan G. Komen. If you're watching us on YouTube, there's a donate button next to the video or under if you're in mobile. If you're watching us on Twitter or on LinkedIn, you can go to YouTube and donate. If you get any value out of what we're doing today, we would really appreciate it if you would donate. It's a great cause, and we'll get into that in a second. But if you can donate, if you're watching, we would greatly appreciate it. And with you, we're actually going to start out with Susan G. Komen because you actually started an ETF for the benefit of Susan G. Komen, which is really, really cool. So I'm wondering if you could just talk about Simplify, the Simplify Healthcare ETF and what you're doing there.
Sure, absolutely. So Simplify approached me several years ago to put this together. And it is the first ETF actively traded by myself. And the fees associated, the profits that would go to Simplify, go to the Susan G. Komen Foundation for breast cancer. And so I get the honor of giving to the Susan G. Komen Breast Cancer Foundation every single day. And this is what I do for a living, essentially trade this fund and give it away. And so our investors get to keep the returns, but the very modest fees that are associated with this will go to that charity. And I should add that it changes every day, but I'm among the very top shareholders in the Pink Fund. So I trade it as if it is my own money because very much it is my own money.
It's such a cool idea. Like, where did you come up with the idea? Like, it's really interesting.
Mike Green and I had been kicking it around. For those of you that don't know the much esteemed Mike Green,
he'll be joining us shortly.
He's as brilliant as he is tall and good looking. And he a wonderful guy, and he works at Simplify, and you can see him on almost one or two financial programs every single day. Incredibly active in the community and a very, very good friend. He and I have been close friends for got to be 15 years or so. And we talk about every day. But he approached me about this many years ago, what to do, how can we get something together? And this was the result of those efforts.
Can you talk about your background in healthcare? Because you were actually a scientist, right? Before you were a money manager.
Sure. Yeah, I did drug development, old school, belly to the bench, as we call it. And so I developed drugs in the 90s and then discovered that this job existed. I didn't know. I lived in a laboratory. So please don't blame me for not knowing every job that's out there. As soon as I discovered this job existed, that was the moment, aha. And I went to business school to learn what finance was. And then I went to Wall Street, and I was very fortunate to right away get a spot at Oppenheimer Funds as their head of healthcare in a very short period of time, and then just ran with it from there. Ended up at hedge funds in the 2000s, and then spent most of my career at Citadel and Millennium. And that's where my fund, Critical Mass, came together at Millennium, and I ran that for most of my career, and really for the past 20 years. So doing the Ping Fund is certainly not a big leap from what I normally do.
Do you think your background as a scientist helps you a lot in investing? Like, you see a lot of really successful money managers come from an area completely outside of investing and then be really successful. I mean, do you think that helps you?
For the most part, it helps. I always have to be conscious that over time, being an expert in something, you garner biases. And those biases can be, I don't want to say they can be good and bad. Good because I can weed out things that very quickly probably can't work, but bad in the sense that the rest of Wall Street can't do that. So you can have tremendous trading opportunities that I might overlook because of my biases. And that's something I try to stay very, very conscious of, is that it's not what I know versus what they know. It's when are they going to figure out what I know? And that is the trade. Early is being wrong. So I have to be very keen to the perceptions as to any new technology out there. And just if I think it's not going to work, that doesn't mean it can't be a great trade to the long side. Or if I think the market is much smaller than the street believes, that's a different trade. There's a run-up trade into the great anticipation. And those are the things that I have to really monitor and think about in order to make money for Pink. Because at the end of the day, my job is not to be right. My job is to make money. Being right is for people who write books. For the most part.
That was a really cool quote from our original interview with you that I shared on Twitter, which is this idea of you go big when they figure out what you already know, which is in terms of position sizing, which is a really interesting way to look at it. It's not a way I'd thought about it before.
Yes, I'll give you an example today. There's a chemicals and materials company called 3M, and they just reported today, and it is coming out to they are figuring out what I know. And this is a big position in Pink that's way outside of the benchmark, meaning that it's not represented in the benchmark. So it's a meaningful bet. And it's up, I don't know, 6, 7, 8% today. And I think that this probably has 50 to 70% upside over the next year as new management takes over. And we have a management turnaround for what has been a troubled and forgotten company for a very, very long time. It's extremely cheap, and I think they're going to be beating on revs and margins, and maybe meaningfully on margins as management improves the throughput at the company. These are the sort of things that I will spend a lot of time on, figure it out, have a position on, and then wait and watch for that moment that they start to figure out what we've done the work on. And that's a great example, and it's represented in very large size in the Pink Fund.
Can you talk just at a high level about what you're seeing, like in healthcare right now, what you think the biggest opportunities are at a high level?
At a high level, so there's always going to be new product stories. And that's one of the great things about healthcare, is that there is always new innovations that are coming and going because they expire on their patent life. And so that's one thing that's ongoing all the time. And that's part of my job, is to dice through that, figure out what's going to work and what's not going to work. The other piece that's very meaningful is what the macro economy is going to do. Healthcare is sort of stuck in between defensives and offensives, meaning growth stocks when the economy is good. And we are very likely moving into a transition where the economy is going to decline very, very quickly. And so I have to think very hard about how to position for 2025. And that's where I'm spending an awful lot of time right now. Just about every single really, really great trade that I've ever had is a year to a year and a half in the making. And that's what I really try to time things out, is understanding what's going to happen in a year and then when to put it on. And so I'm thinking an awful lot about how to put this book together for the fall, thinking about not the fall, but thinking about 1Q, 2Q next year. So those are the things that I'm working on and thinking about from a top-down level.
Yeah, I can assume that's a pretty challenging thing, because you've got these great companies doing really innovative things, but then on the other side, you've got the economy, and they're influenced by the economy like everybody else. So balancing those two things, I would assume, is a huge challenge.
I have to be very, very selective and nimble. And I treat it like it's my money. So I'm just going to pull up while we're talking here my portfolio in pink so I can speak to it if you need me to speak to it.
Can you talk about just some of the innovation you're seeing in healthcare? Like, people like us who are outside of it, I mean, we know there's world-changing things coming, but we don't know exactly what they are. Like, what are the areas where you think healthcare is going to change the world the most, in the coming years?
Healthcare is incremental, like many scientific projects. It's all baby steps, and there's rarely giant leaps. Now, a giant leap, though, could be a big product like the GLP-1 class for weight loss and heart disease. But that's not a new class. For instance, it'll be an innovation maybe to the public because they're now finding out about it, but it's been available for 7 years in different forms, more than 7, in fact, 10. So it's all incremental, and it's baby steps. But I will submit that those baby steps over the past 20 years have added up to profound results for patients and payers and doctors and productivity for the world. And when I started, the antibody, that was new 25 years ago. There was only a handful available, and they can, for the most part, turn off certain protein or signaling pathways that delivers tremendous results to a disease, specifically cancer, autoimmune, things like that. And now, over the past 20 years, now we have viral gene therapies, RNA gene therapies. We even have kind of gene therapies that will insert new genetic information into certain types of cells to have a profound impact. This is all new. When I came onto Wall Street, I was a molecular biologist and a virologist. And if you went to the textbooks that I just walked out of and the classes I just walked out of, we thought we had it all figured out. We knew how a cell went from a signal to the nucleus to change the DNA read profile, to make the RNA, to make the proteins, to have an impact in development or a morphological change in the cell. And we learned that, yeah, that's totally not how it works. There's many, many, many more layers of editing that occurs in between here and there. And so even the dogma of how things work in the cell has changed profoundly in the past 25 years. I submit that it will change even more so in the future, and we will learn new things about how our bodies work. What's significantly different, though, is the velocity. The velocity has changed. The toil that I used to do at 2 a.m. in the laboratory in 1998 is epic. And it was one guy with pipetters and going from heat bath to cool bath to a fire to whatever, to a machine that would code out my DNA and read it. And I have to go with a ruler going through and say, A, G, 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 G. I'm literally reading it by hand. They don't do that anymore. Machinery has taken over much of this. And so you don't have the guys in the lab at 2 a.m. toiling as much. Now you have 100 machines doing 2 million times the output of what I could have done by hand 25 years ago. That's what's changed. And that has changed the velocity and let's say the fidelity of what can be done. We can go now from the whiteboard over here, from an idea to the whiteboard to a drug concept screened pretty darn quick now to animals to human in sub 3 years. That's incredible. And I don't mean approved in 3 years, but I'm saying you're in humans from an idea on a whiteboard within 3 years or sooner. And that is breathtaking, how fast the velocity is. So the amount of content that has come out scientifically is stunning and overwhelming for an analyst trying to keep up with all this information that's constantly getting poured out. And that's really part of the battle: is how fast can I learn? How fast can I process and then trade for the pink fund?
You mentioned GLP-1s. I mean, to an outsider like me, it seems like that is a game-changing thing. Is that the case?
Well, in my view, there's probably about 75 million Americans that should be on a GLP-1. So about 25% of the entire population or so. And so that's profound. Uh, Look, humans are designed to pack on the weight because, through evolution, genetically, our biggest fear of our bodies and our primal mind is don't starve. And so we are programmed to overeat and put on weight. And while that will keep us alive in the short term, while there's no food in the winter and we're in a cave, in the longer term, it has terrible impacts on the body, around the cardiovascular and so forth, and a lot of inflammation. This is the first class of drugs that can, let's say, fool the body into thinking we're sated. Not all the time, not completely. But for most people, you simply eat half your lunch instead of all your lunch. And that reduction in caloric intake has a profound impact on the body and the mind. So, and it's a good one. So I think that it's going to be a gigantic drug class, the biggest ever. And I can't wait to see what comes out next. And again, it's all incremental. We're going to see these injectables go into more of a pill format over the next 3 to 4 years. And that will extend the IP life for many of these companies. And then that too will go generic. And so 15 years from now, we're going to have a whole suite of drugs that are going to be for pennies every day and can have a profound impact on the weight and cardiovascular health of patients. So that's incredibly powerful for humans to live better and live longer. So GLP-1 is going to be big. It already is. It'll be much bigger.
Mike, can I ask on that point? I mean, I think LOI, it's up 5, 6, 7% this morning. Is that trade likely done because that information is fairly well known at this point, or do you think that there's more kind of life left in that trade?
Oh, there's tons of life in that trade, in my view. And the reason is it's not covered. The drug is not covered largely for Medicare patients. And that's really where the big market is everybody 62 and over. Of the folks that are 62 and over, probably half should be on a GLP-1. It will greatly improve their lives. They're sleeping. It'll improve sleep apnea. It'll improve their hearts. It'll improve their liver. It'll improve their kidney. It'll improve their mobility. It'll improve their hips, taking the weight off of those old hips. So, and that will be covered incrementally throughout the year and years in the future. The government doesn't tend to do it all at once. They like to take their time with these sort of things, especially when it's really good for humans. They like to say, well, maybe not. In my experience, they're more concerned about the financial impact than the health improvement in their patients.
Another area that people mention a lot in terms of something we're going to see a lot of innovation is this idea of aging. I don't know if it's going to be too late for me, but it seems like we're going to be doing a lot of stuff in that area. Like, what are you seeing in the area of aging?
I see a lot of early science for the most part. But I do think that is very likely in our lifetimes going to be the next really big drug class. Just because I think we're getting closer and closer to having a plan on how to attack aging. And part of it is figuring out what is aging. What is it? For a while, I thought it was because the caps of your chromosomes start to decay, and that's a sign of aging. And so they tried a number of drugs to extend the caps of your chromosomes, things like that. Didn't work. But I don't want to go into all the details of it because I don't want everyone to fall asleep. But that is something that I'm watching. And the thing is about science, which is so great, is that I won't miss it because I will be watching this like I have been for the next 20 years sitting here reading, just like I did for the previous 20 years sitting here reading. And it's all small increments as we move forward. So it won't surprise anybody. I don't think there's going to be any big shocking drugs that come out. One that's extremely interesting to me that I should bring up is Regeneron is going to have go into patients for a drug that may be able to cure allergy. That is really, really, really big. There are millions and millions and millions of patients that suffer from severe allergy. And that'll be the first time we can see an outcome from here. But I'm looking forward to those first patients. And I think on paper, when I write it down and I go through it, I'm like, that's probably going to work. So we'll see. But those are the sort of things that I'm very interested in, and everything else, honestly. But I just wanted to give you a couple examples that are big.
How about cancer? I mean, we're here today to support Susan G. Komen to help fight cancer. Like, what is your outlook for cancer? I mean, is this something we're going to be able to cure or at least reduce to something you can live with over the next, 10 years or so?
I think that's the key. It's developing a relationship with cancer where it's there, but it doesn't own you. And I don't know if we'll ever be able to get rid of it for many patients. I think it'll just be let's say an armistice where we simply have agreed to the lines and we will not cross them. So the cancer is there, but it's in check. And so we have this ongoing battle in your body of we're fighting the cancer back and it stays pretty small. The drugs are there to help and you can get on with your life and live a pretty darn normal life. And we've seen that in many classes, especially leukemias, where patients will still endure a leukemia for a very, very long period of time. And they will live to a ripe old age and die of something else. So we're getting there, and it will be incremental from one cancer to the next. But when you look 20 years down the line, we're probably going to see that for most cancers, where these things will just simply be in check and you can get on with your life. And diagnosis will play a very big role in that, finding it early. Right now, we're at the spot where there's been a lot of efforts to try to find cancers, detect cancers early with a blood test and so forth. Unfortunately, they're not very good. And honestly, the results that you get are not terribly useful because your cancer level may be so low that they can't find it. So what do you do with that information? Do we treat? Do you just live under a scary cloud for the rest of your life, knowing that maybe kind of, sort of, somewhere you have cancer and maybe you don't? So we're not at the point, I think, where that can be prime time. But again, it's incremental and we'll get there into the future.
You pulled up your holdings, so I want to give you an opportunity to use them. Like, how do you think about taking all of this innovation we're seeing in the healthcare space and turning it into a portfolio?
Look, our job for making a portfolio is to deliver asymmetric returns. And sometimes it requires having a lot of innovation in that book that is not well understood. And there are other times when you want to not have that innovation in the book because that's not the right time to do that in a macro sense. So I do move it around an awful lot like I would and do my own money, figuring out what is correct in the risk-reward paradigm. So, for instance, right now, our largest position is a gene therapy company called Sarepta. And I believe that they are going to get a very large label at the FDA for Duchenne's muscular dystrophy. And the over-under is that most folks don't think so because the data that they came out with in their phase 3 was imperfect. And that's sort of the argument. I looked at this and said, no, the FDA is going to sincerely like this. And that's the debate. And so I can think about what the risk reward is there. And so we have a meaningful position that that information, what's called the PDUFA date, the approval date, will come in June and might come a little sooner. But I think that the NPV, when you take a look at this company, for instance, I think that they're going to do over $5 billion in revenue next year, and it's around a $12 billion market cap company. So, and what the investors are getting wrong is that there's a meaningful residual. There's a meaning that there's a large population. Well, it's small, the population for Duchenne's muscular dystrophy, but the incidence of DMD, Duchenne's muscular dystrophy, the incidence of DMD will still garner for them about $1.5 to $2 billion a year in residual revenue once they go through the DMD population. So when you add up the sort of NPV of this company in their market, I think that this is worth closer to $30 billion rather than 12. So I would anticipate it doing extremely well this year on the numbers that are going to come out and the label that'll come out. So those are ways how I think about our investments. Normally, I wouldn't be as large in a company like this in this book or even my book or any book. But when you do find you have asymmetric understanding and you believe that you have the nuts, you have to bet like you have the nuts, because my job is to make money for you and make big donations to the Susan G. Komen Foundation. So that's what we're going to do.
Hopefully both with the ETF and today, we're going to do that. Just in the couple minutes we have left, just a couple quick questions. You had mentioned earlier you're not very optimistic on the economy. So I just wanted to give you an opportunity to talk quickly about why that is.
Well, let me phrase it like this. I am optimistic that the innovation that comes out of the U.S. economy and the United States in general is unparalleled. And so this is really the place to be investing for the most part. Smart people, an accommodating government, and meaning that they allow business to flourish for the most part. And you put those things together and it generates great things. And we've seen this now for 200 years out of the U.S. But for the past over a decade, we have had a command economy, which we've never really had before, especially during non-wartime, a non-crisis moment. And the government has determined what the GDP is by overspending, and overspending in a grotesque way. And it's fine until the bill comes due. And we are witnessing right now that bill coming due. Think about the government, how it's financed. It's financed essentially for the vast majority on 5-year paper, like a ninja loan, right? It's a teaser rate and it begins to roll over every year. And we had tremendous spending. And as this debt rolls over, they're having to pay higher and higher and higher interest rates. So that next year, the interest, the coupons that they'll have to pay is about $1.7 trillion rather, and in total. And that's as much as Medicare and Medicaid put together. So that number used to be a much, much, much smaller number of the budget. Now it's huge. And we don't get anything out of it, meaning that there's no fiscal spend that gets drilled into the economy with them paying those coupons. This is sort of the downfall of government largesse. And so next year, in order for us to have similar GDP growth as we did this year, which was modest, the government is probably going to have to spend $3 trillion of excess fiscal spend, meaning that they'll be bringing in about $5 trillion of taxes, which they spend, and then $3 trillion on top of that, and maybe more. I don't think that can happen. I don't think they're going to get a budget that even remotely looks like that. I think it'll be a more sanguine and a touch more balanced outcome. Well, people might applaud that and say, that's great. Well, it's not great when you're in a command economy. That spending reduction, or let's say less of a comp, the reduction in growth, will have a profound impact on the overall economy. So I think we're setting up for a very, very difficult 25.
Well, thank you so much for joining us. We really appreciate it. This was awesome. Thank you for helping us raise money for Susan G. Komen. Yeah, we really appreciate your time today.
It was absolutely my pleasure. And we went to Susan G. Komen because they can deliver big results from big checks. And many of the funds, charities out there can't do it. They don't know what to do with a $5 million check. And that's where we want to be. So I applaud them for doing such an amazing job and putting that money to work in a great way. And we'll just keep forging ahead and putting up the numbers. All right.
That's great. It's a great cause. Thank you again for doing this.
All right. Thank you guys. Have a great day.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.